Hello, good afternoon, everyone. Thanks for dialing into Marcellus's next monthly CCP Consistent Compounders webinar. Today in this webinar, we'll be talking about a theme of disruption that we notice many of our portfolio companies undergo, especially after a crisis. The last couple of years has been one such period, and several of our portfolio companies are transforming their businesses from what they used to be till 3 or 4 years ago to what they will be in future in a radically different way. This is something which has to be done in order to sustain greatness, and we'll articulate some of these examples. First, from the past, how greatness was created through disruption, and then from the future, how it is being sustained, attempted through disruption. Also, we'll be taking a deep dive into the quarterly results that have come out so far, particularly the couple of stocks where I think the share price reaction to the quarterly results has been quite negative, the likes of, say, Divis, Dr. Lal, etc. And also the positives, which are far more than the negatives from the results that have come out, and hence a pretty healthy set of overall portfolio level fundamental progression. Particularly the outlook for all the companies, including the Divis and Dr. Lals of the world, is very positive. So we'll deep dive into that. So without further ado, let me quickly jump into first of all the performance. So this is the slide. Last 1, 3, 6, 12 months have nothing. Have not been exciting enough to project on this exhibit. The longer term periods, 3 years, 4 years since inception is almost 4 years now. They are healthy absolute and relative returns for CCP. In that light, let's talk about the subject first, and then we'll come to the quarterly results. To begin with disruption, right? We get asked this question quite often. Particularly, this was a very frequently asked question in the calendar year 2021 when all the tech disruptors were getting listed in India. Disruption by definition is not only a technology disruption, right? That's something worth appreciating, worth understanding, because far more frequently disruption is carried out through newer methods rather than through technology. And in fact, technology is an enabler which all non-tech disruptors use to build their strengths in a deeper way through the disruption, which is what has been the theme for consistent compounders, where pretty much every company in our portfolio has radically changed the way in which their industry works by changing the business model that adds significantly more value to their customers in a way that can't be replicated by competitors. And that disruption is actually pretty much the only reason why these companies, they continue to compound, and we continue to stay invested in them. Quickly speaking, this is the exciting phase of disruption, which is something that we all have been aware of in the last 2 decades. Pretty much how I would say an Apple disrupted the traditional mobile phones. But what is the more frequently followed process to disrupt, particularly across all the CCP companies, is to first of all identify a problem, which is actually an opportunity. If there were industries without any inefficiencies, there is no potential for disruption there. Picking up an inefficiency in the current regime is the starting point of disruptions of consistent compounders. And then these businesses have built solutions by totally changing the way in which the industry operates, right? And that change in the business paradigm is carried out through execution of the disruptive solution in a very scalable manner, right? And then the cash hence generated and wealth hence created the compounding is sustained by reinvestment back into the same cycle, back into identifying a new problem and then finding a solution that can't be replicated quickly. Here are a few examples. For instance, Titan has been a disruption of the jewelry industry. Previously, the jewelry industry was all about family jewelers building trust with customers by giving a personal touch to the customer, sort of personalized service inside the store, and jewelry purchase at the same time from a customer behavior perspective was largely a big ticket occasion oriented event, right? You won't buy jewelry for just 30, 40, 50,000 rupees in the sort of 2 decades old era in today's rupee terms. And the way to make money for the jeweler was to play on the commodity, either the commodity purchase and sale price differential, but more often it used to be through the sale of impure commodity sold to the customer in a way in which the customer believes it is pure. So this is about gold. The impurity of gold was the margin for the family jeweler, right? That's how the industry existed for several decades. And this was actually one of the most difficult challenges to address, and Titan attacked exactly that piece by focusing on purity of gold and popularizing the keratometer concept, which measures that purity and offer nothing hidden to the end customer. In addition to that, they democratized the trust rather than centralizing the trust at the store level with the store manager for the family. This is democratization of trust, decentralization of trust through the Tata brand particularly, right? That also led to starting off with jewelry becoming not occasion based to more a daily wear purchase. And then eventually also more recently, wedding jewelry being purchased more and more from Tanishq than from the mom and pop jewelers. Commodity game was totally nullified through sort of business models such as gold on lease being the way to procure gold for Tanishq and other such means, rather than a play on the commodity itself being a way to make money or run the risk of commodity price fall, etc. So totally new business model that Titan introduced. Similarly, HDFC Bank totally disrupted the banking sector. Previously, it used to be time-consuming check settlement processes. There used to be manual processes for clearing houses in stock exchanges. And HDFC Bank effectively brought about solutions to those inefficiencies through various means, and then they enter into the ecosystem of various corporates. And once you've got all the salaried accounts of a corporate by offering convenience around settlement, around clearing processes, then it becomes a very sticky customer base, right? And building on to that customer base thereafter is something that we've seen in the last 2 decades. Likewise, in the diagnostics industry, Dr. Lal Pathlabs, massive disruptor. It actually changed the industry structure from being healthcare industry to a retail industry. 2 decades ago, diagnostics was purely healthcare. Today, if you're not running it as a retail business, then healthcare won't get you any far in the diagnostics industry because of the way Dr. Lal Pathlabs actually pioneered the transition. So initially, it used to be fragmented sort of mom and pop labs all over the country. Doctors' incentivization was the primary reason driving footfalls. And for a lab, the only way to scale up across a city, forget about country, across a city, the only way to scale up for a lab used to be have CT scans, MRIs, radiology, along with pathology, so that you are able to offer the doctor a wider list of menu from which the doctor will get the incentives. That business model, quite naturally, was not scalable beyond, say, 5, 10, 15 laboratories for even the largest of such mom and pop players. And the main reason for that was radiology undergoes massive licenses for establishment, PNDT for the doctor, for laboratory, for machine, etc. Very asset heavy, difficult to scale up in a very easy manner. Plus, there were many conflicts of interest. Obviously, that was a challenge that the industry underwent because the footfalls were driven by the doctors rather than doctor just offering the sort of consultation and diagnostics being independent. The solution was, run it as a retail, as I said, in a hub and spoke manner, where sample collection and lab testing were sort of de-linked from each other physically, and franchisees started replacing doctors in terms of the share of the spending for the diagnostic player going towards running the operations, driving the footfalls, and turnaround time and supply chains at the front end became the way to make more money rather than just the doctor referrals, right? And in pretty much all the top 15, 20 cities, doctor referrals have reduced to very low levels, if not negligible levels. And it's only the smaller cities where, again, there's a downward trend in doctor referrals, and the business model is getting disrupted across. Massive operating leverage in running diagnostics as a retail chain, the benefits of which are passed on to the customers through non-price hikes by players like, say, Dr. Lal Pathlabs, right? I think 2016 onwards, Dr. Lal hasn't hiked product prices for its menu card, right? So that's how Dr. Lal actually disrupted the diagnostic sector. Adhesives, similarly, it was a transition from B2B to B2C, right? Adhesives used to be a proper B2B business previously. Poor product quality, animal fat-based products. I remember glue was more often than not used rather than chemical-based adhesives, and very time-consuming process for drying. The furniture quality outcome would be weak, very low. The solution that Pidilite came up with was a proper R&D engine. Fevicol was born. More recently, things such as, say, Heatex, which is a massively R&D oriented value add, fast drying, quick drying adhesive, premium quality, fabric glue, completely new category created for adhesives. So that's on the product side. Pidilite ended up disrupting the whole industry through product innovation. A lot of focus on carpenters, which nobody previously did, and a lot of innovation in advertising. I'm sure everybody has seen and enjoyed the advertising and marketing of Pidilite over the last 2 or 3 decades, which made the business a B2C business from being a B2B business. And that was also the reason why it became a sort of a monopoly in adhesives. And top up on top of this business model were acquisitions, such as, say, a Dr. Fixit, Roff, Steel Grip, MC, etc., which were carried out over the last couple of decades. Right, that's the Pidilite disruption. Divis, similarly, disrupting the sort of global pharma API manufacturing and custom synthesis industry. Previously, India's pharma industry was only based on trust. Sorry, not trust. It was only based on outsourced manufacturing because of low quality, of low price points of labor offered by Indian pharma players, and these drugs would be exported, sold in the US, etc. And that was the standard sort of pharma industry: manufactured in India, cheap pricing, and sold abroad, which was totally disrupted by Divis. The custom synthesis business that Divis runs is purely based on trust, and we'll talk about it in a minute. The API, generic API business is totally based on quality, timely delivery, low price points, and scale of operations, very different from the old pharma industry, and an impeccable FDI clearance record, barring just one instance in 2017, where there was a warning, and apart from that, very different from the standard Indian pharma. Right, that's how Divis changed the industry. Bajaj Finance that's another example, great example, where consumer durables lending previously was nothing like what Bajaj Finance started, where the money was not made of the customer really directly. The money was made of the Samsungs and LGs of the world when they sold consumer durables via zero cost EMI to a customer, and rest is history. How Bajaj Finance, starting from there, it used technology and operating efficiencies to scale up the business in a way that NBFCs never used to run previously. Very quickly, these are examples that we've talked about in our previous webinars. Innerwear. Previously, India was totally flooded with substandard product quality. Wholesalers would sell these products where there would be no trial rooms. Customers will be very shy in buying these products. Advertising was through Bollywood celebrities, very expensive, and Page did completely the reverse of all of this. When Jockey entered, the product quality was the focus. The aspirational brand recall got created without Bollywood or any international celebrities. It was all Caucasian models. And it was distributors and EBOs being used with trial rooms rather than the sort of shy purchase behavior of customers for innerwear. And last but not the least, from the portfolio, an example, Asian Paints. I'm sure all of you are aware of how we view Asian Paints as a tech company, as a supply chain company. It's not really a paints company when it does paint inventory turnover as the only reason why a dealer stocks Asian Paints' products. And it's actually deepening of its tech initiatives, its demand forecasting, which is what has totally disrupted the paints industry and created dominance for Asian Paints. Now, that's the history. But as I previously mentioned, disruptions must be continuous. If they're not, then greatness isn't sustained, which is where I think what has happened in the last 2 years is quite phenomenal, right? Titan has totally transitioned. Carrot Lane, quarter after quarter, continues to grow at more than 50%, 60% year on year. I think the last 3 years, CAGR is more than 70%. Highly profitable new revenue stream created via Carrot Lane. Eyewear business for Titan has totally turned around, experimenting with a couple of newer formats, sarees and handbags, and a couple of other merchandises. And it's a new Titan as a result. It's not the old Tanishq only, non-wedding jewelry only oriented business. It's transitioning, it's disrupting in newer areas in addition to Tanishq. Bajaj Finance is doing fintech in exactly the reverse way as what the fintech industry has been used to. The fintech industry is a standard business model is burn cash, raise low-cost debt, raise low-cost funds, and then burn them to acquire customers, something that is very smartly called customer acquisition cost. And then the business probably never makes money, but acquires lots of customers till the time it exists. Right? Bajaj Finance is doing exactly the reverse. It's acquiring customers via the lending platform, and only through the existing customer base, it is offering fintech as an add-on, as a top-up. And hence, no wonder the fee income for Bajaj Finance has been rising quite remarkably. The value add to the end customer is significantly more than what it used to be. And the fintech industry, as a result, you can see it getting disrupted in front of us. Competition obviously is falling by the wayside, particularly given the rising cost of capital, which makes life difficult for customer acquisition cost oriented fintech players. And all the other examples as well. Asian Paints, in our previous webinars, we've talked about how home decor foray has been expanded into. More recently, they announced backward integration to sort of manufacture ingredients for paints, VAM, VAE in particular, and even white cement manufacturing, which goes into putty. Remember, Asian Paints has already taken a lion's share of the putty industry in the last 3, 4, 5 years, away from the larger players such as, say, the Birlas, the Grasims of the world in a way. And with backward integration, I think the business model here will get created with cash generative prospects as well, not just a foot through the door into the cement dealership network that they got in the last 3, 4, 5 years. and possibly also an experiment which might or might not work, the way we see it, around adhesives through the backward integration piece, right? That's an accelerated capex plan which Asian Paints has embarked upon. Again, likely to change the way business models in paints, putty, white cement, and adhesives might work in future. Page Industries, fully automated front-end supply chain, biggest benefit due to the auto replenishment systems and demand forecasting systems that have been put in place. The product portfolio of Page has widened significantly in the last 1.5 years, right? So if you remember, for instance, when it comes to women's innerwear, Jockey was all about comfort-oriented SKUs. Particularly in the last 6 months, a lot of fashion-oriented SKUs in women's innerwear have been launched, right? So strapless, lacy, all of those products which were not under the Jockey stable in wide proportions have been introduced. Outerwear, many of you would have noticed the expansion of the outerwear product range or the marketing through out of home that more recently we've seen it being done in an aggressive manner. Outerwear is far more number of SKUs per unit customer base compared to innerwear. Remember, you can always go for 4 or 5 pieces of innerwear of the same look and feel, but you won't go for 5 t-shirts of the same look and feel. You won't go for 5 track pants of the same look and feel. And as a result, the ability to handle outerwear's number of SKUs, women's innerwear number of SKUs, kids wear number of SKUs, right? That ability, it can't be created without significant automation and tech intervention in the front end supply chain. But if it is automated, that's a disruption for you. No other player has done men, women, kids, outer, inner, across the board, wide product portfolio in an efficient and scalable way in India in the past, right? This probably is the first firm which has done it and continues to sort of push the boundaries, which have been the more recent disruptions. Pidilite, again, new revenue growth drivers getting created via few acquisitions and a lot of automation here as well in the replenishment with distributors at the front end. ICICI Lombard distribution channel acquired from Bharti AXA in a way is a massive addition which we've seen in the more recent past in their reported numbers as well. So that's about how we see disruptions being carried out. A lot of excitement, some of which has started trickling into numbers now. A lot of which will keep coming through in the next couple of years, 2 to 4 years. This chart, this table shows you the way quarterly results so far have been reported in the financial space, barring HDFC Life, which we'll quickly talk about in subsequent slides. Barring HDFC Life, there isn't any weakness visible here. In fact, the loan book growth of an HDFC Bank, a Kotak, is stronger than any ICICI Bank, any Axis Bank, any other bank. It's the highest 2 loan book growth companies for a few quarters now. The profit after tax growth, obviously, barring the recovery in NPA from very high levels of NPA to relatively low for some of the competitors, barring that element, profit after tax is again very, very healthy, sort of 20-25% number. Bajaj Finance continues to grow at the fastest pace amongst lenders, as always, and one of the reasons why it is also one of the highest allocations in the portfolio. ICICI Lombard, massive market share gains and a lot of investments in new products, particularly health insurance. ROE is healthy, revenue PAT accelerating. HDFC Life, it's a market level moderation. Quick reasons, very high base of September quarter last year, because after the Delta wave shutdown in businesses during the first quarter, the June quarter last year, there was a lot of pent up demand which came through into July, August, September. And on top of it, ULIPs for the overall industry, where HDFC Life is less exposed compared to competitors. ULIPs are not doing well, obviously, given the weakness in broader equity markets. Very strong margins, very strong ROEs, market share marginally increased, no relenting there. And as I said, we'll show you some more data points here. Asian Paints, TCS, Titan, very strong, healthy revenue growth rates. TCS temporary margin compression, which we expect to normalize in future as salary costs, availability of talent becomes far better, more normalized, given the rising cost of capital and disruption of various types of demand centers for that talent. Titan, Asian Paints continue to sort of create newer revenue growth drivers. Volume growth for someone like an Asian Paints continues to be sort of 15 to 20% on a 3-year CAGR basis, very consistently quarter after quarter. Dr. Lal Pathlabs page, again, revenue growth healthy. On the margins front, there are some one-offs, not much to read into. Will be normalized, and Divis Labs. Probably this is the stock with which we should start our stock specific discussion. So I'll probably spend 10-15 minutes. I've also got Sudhanshu, from our pharma analyst, to talk more about it. But before I hand over to Sudhanshu, let me just articulate the sort of business model of Divis, and then Sudhanshu will take you through the specifics of how we see the quarter that has gone by and how we see the next 2, 3, 4 years panning out. So Divis has two parts to its business. The first part is custom synthesis, right? Which is, to put it very simply, it's made to order products, made to order molecules, right? These are made to order because either they are patented or they are customized products from the big pharma. The customer here is big pharma. The customer is not the household owner of the household consumer of the products. Divis sells to big pharma, either patented products made to order or customized, right? The moat here, the competitive advantage here is trust. These big pharma companies, when they buy from Divis, they do not want Divis to let down their guard on trustworthiness, which means that whatever Divis does for the big pharma in no way can be misused or can be leaked to competitors. And this is the key reason why Divis gets this business. No other pharma company in India has built a level of trust of this degree. And this is probably one of the stickiest revenue growth drivers that a pharma company can have, right? Having said that, since it's made to order molecules, their their sort of longevity is relatively limited, because once the patented product goes off patent, right, obviously many other players will enter into the manufacturing, the pricing will drop, and the competitive advantage is no more around trust. So there will be a limited life to the patented products, and even for the customized products, the underlying demand for the drug might go away. One of the examples of custom synthesis worth highlighting from the recent past is Molnupiravir, which was an ingredient into COVID-19 related drugs. And Molnupiravir saw massive increase in sales during the 3rd and 4th quarter of FY22. And now that COVID has sort of started to go behind us, we see Molnupiravir having a limited life, limited contribution to Divis. Now, because of this limited longevity of each product in custom synthesis, the strength here also has to come from newer and newer addition to the product portfolio of custom synthesis for Divis, by either deepening of existing relationships with big pharma or addition of new relationships with big pharma customers, right? So that's really the half of the business. That's the more lumpy, at times volatile as well, part of the revenue for Divis. The second part, the second half, is the generic API part, where these are off-patented drugs which are manufactured at scale, right? The competitive advantage here is, first of all, timely delivery of products to, again, the big pharma companies, because these are APIs, these are ingredients that go into, let's say, cough syrups and painkillers, where Divis is sort of 40, 50, 70% global market share in naproxen, dextromethorphan, etc. which are sort of commonly used APIs into cough syrups and painkillers globally. First of all, being able to deliver at scale in a timely manner. Secondly, being able to sustain high quality of production. And third, cheap price points offered to the big pharma as customers is sort of a three-pronged competitive advantage that has to be built here, which is where Divis does backward integration and operational efficiencies like no one else. And it's a massive barrier to entry, provides a very consistent demand drivers for Divis's revenues overall, right? Now, last 6 months of developments, while I'll let Sudhanshu talk about the reasons for moderation in revenue growth momentum in the last couple of quarters, there's a huge pipeline of products that are getting added, which are likely to fuel massive acceleration in growth after a couple of quarters. And this is not the first time. Every once in a while, Divis goes through this volatility, and we'll show you a chart on that in the next slide. There are, broadly speaking, 3 or 4 massive new revenue growth drivers getting added, right, which you should look forward to. One, there are massive fast track opportunities in custom synthesis. Now, what is fast track? So typically, Divis would see the big pharma offering products when the product is still under phase 1 trial, phase 2 trial. Remember, there's phase 1, phase 2, phase 3 before sort of the patent is granted and commercial production starts under patent, let's say. Typically, it would be phase 1, phase 2 when Divis would get involved. Then there'll be 2 or 3 years of phase trials before which the drug might become ready for manufacture at scale. But what Divis has achieved in the last couple of years through Molnupiravir particularly is a very quick ability to shift gears, manufacture at scale a product which Divis never manufactured in the past, which big pharma needed in large quantities with short deadlines, and Divis has delivered on that. And the word has spread, we understand, the word has spread globally now amongst big pharma that Divis can be given drugs in even phase 3, even advanced stages of phase trials and execution thereafter with short timelines at scale. Now, as a result, if a big pharma needs volume and quick pace of execution, Divis is starting to become the sort of amongst the preferred vendors for big pharma. Now that is potentially a massive addition to revenue growth drivers in future. And then there are lots of other areas around nutraceuticals where there's substitution against one existing big pharma company. API is a massive patent expiry opportunity in the next 2-3 years, and some China plus one substitution potential for manufacturing. So at this point, I'll just request Sudhanshu, our pharma analyst, to talk a little more about the fundamentals of Divis. Sudhanshu?
Sure. Thank you, Rakshit, and good evening, everyone. So Rakshit just mentioned about the volatility in revenues of Divis in the recent quarter. What I would like to draw is draw your attention to the chart on the screen. As you can see, this volatility is not something which has happened just recently in last couple of quarters. This has been more or less like a feature in Divis's business model. And this is because the very nature of this business warrants this kind of behavior in the revenue trajectory. When we talk about Divis's business model, when we focus solely on the custom synthesis segment, this segment, the demand of underlying molecules is driven by a couple of things. The success of phase 1, phase 2 trials, which Divis is making the molecules for the big pharma clients, the approvals that they get, the commercial operations, commercial success of these products, etc. All of them happen to be very lumpy and very, very unpredictable, because you can't predict whether a particular molecule would be very successful in phase 1 and it would show similar success in phase 2. Because of this volatility, the business mix on a quarter-to-quarter or a year-to-year basis actually varies a lot for Divis. Sometimes it's in the favor of generic APIs, sometimes it's in the favor of your custom synthesis APIs. And this leads to this kind of volatility which we see on the screen. Now, because of this volatility, The share price also behaves in a volatile manner for short periods of times. But when we see over a longer period of time, it is a single direction in which both the revenues and the share prices have moved over the last 18 years that we see on the screen. Now, coming on to the recent results for Divis, which was the Q2 of FY23, what we see is that revenues were affected in this particular quarter by the unpredictable nature of custom synthesis business. So in this particular segment, there was a 33% quarter-on-quarter decline, which amounted to roughly 400 crore rupees in absolute value. Of this shortfall, around 60% was basically the lost sales of this particular COVID molecule, which was any which way is expected to be a one-time kind of opportunity. The rest of the decline was primarily on account of lumpy offtakes of certain non-COVID products in Q1, which impacted the volumes in Q2. We continue to monitor this offtakes of non-COVID molecules along with the pipeline which Divis is building. That being said, we do not believe there is any change in the fundamentals of the company. Rakshit mentioned a few things. I'll like to add on to that. The generic API segment of the company, even in Q2 FY23 that we saw, it has stabilized after 4 or 5 quarters of basically both suppression of volumes as well as significant price erosion. These non-COVID molecules are back at a healthy run rate and should start growing from this point onwards. Secondly, even when we see the business mix in Q2 of this particular financial year, where the contribution from generic APIs was higher with 57% share versus 47% in last quarter, the gross margins of the company have remained stable and very healthy at around 63%. This points to the efficiencies that company has been able to build in its generic manufacturing. The benefit it is deriving from several backward integration projects, and also it also reflects the pricing power of the company. Beyond these things which were there reflected in the Q2 results, Divis is actually building on its strength and execution track record, and it is currently adding multiple growth drivers which would help it in the coming years. I'll just highlight few of them which Rakshit has also briefly touched upon. First of all, a company is actually adding a very different kind of API to its portfolio called the contrast media, which are used in your CT scans. Currently, it is also entering into MRI contrast media APIs. In this segment, company has already completed the validation of its product by one big pharma company. It is in the process of getting the regulatory approvals for commercial launch. Also, couple of other validations are underway with few other big pharma companies, which all point to basically contribution starting from these products in the near future. Secondly, the generic API portfolio of the company, it is set to expand massively over FY23 and FY25. As the molecules which Divis is targeting in this particular segment, they are going to go off patent. The current end market sales value of these molecules is around $20 billion in the today's terms. From this particular segment, Divis has already started filing certain DMFs in order to start commercial supplies as and when these patents go off patent in the coming few quarters. Lastly, this track record which Divis was able to create in molnupiravir, probably this is a world record in the sense starting from a lab scale product all the way to global volume shipments within a span of 6 months. There is no other company which has done it in history. So Divis has now, because of its execution capabilities, the trust that it had built with the clients and all those aspects, it has time and again delivered to all its clients. But this was special in many forms. Because of this, many of the clients which were earlier giving it phase 1, phase 2 molecules are now sending in queries for phase 2, phase 3 molecules. Now, there are a couple of differences when we talk about or what is the impact of having a phase 3 molecule versus a phase 1 molecule. The volumes go up, the chances of commercial success are relatively higher, which means the revenues in the future would be substantially more than having a phase 1 or a phase 2 molecule. So these particular aspects point to basically a good pipeline for Divis in the coming years. I would also like to add, as per management, they have already received 2 phase 3 molecules in the last 6 months because of their success in molnupiravir. So all in all, all these basically factors and the pipeline that the Divi company has been building up point to a robust fundamental performance, which should be sustained over the years to come by the company. Thank you. Over to you, Rakshit.
Thanks, Sudhanshu. So many of you might actually now be raising a question. Let me preempt it. That since COVID is behind us, Molnupiravir was supposed to decline or expected to decline in Divis's revenues. Why didn't we sort of take corrective action to positions in the portfolio? Now, 2 points to that. To begin with, we entered Divis in our portfolio. Well, let me put it like this. So we entered Divis 2 years ago in January 2020. Jan 2020, we made an entry into Divis in our portfolio at an X% allocation. After a while, particularly after the sort of share price started rallying significantly, this was dropped down to 50% of X in the portfolio. And more recently, those of you who are clients, you can see there is a recent increase, right? After the stock has come down from, I think, 5,000 plus levels to 3,500 odd levels, right? So that's something that we've certainly consciously done. But more importantly, this is not something that can be perfectly timed, and you can't sort of play entry exits. Basis CSM business volatility, partly some of which could be expected. And it's worth looking at this chart and understanding. So if you really see, let's say, the March 09 period, where obviously the stock market bottomed out, but the Divis share price certainly did bottom out. In the subsequent 3 or 4 quarters, the revenue growth continued to be negative, but the share price continued to go up because the pipeline that delivered 40, 50, 60% year-on-year growth from, say, June 2010 quarter onwards, consistently, that pipeline started becoming visible, believable for the market. Likewise, the share price in June 17, obviously here there was an FDA, there was a regulatory warning letter received, and then it was pulled off, and hence that had a bigger bearing on the share price. But when you look at the revenues, the recovery in revenues back to positive levels, right, happened far later than the recovery in the share price, right? Another way to look at it is like this. In the March quarter 2022, so last quarter of FY22, Divis reported, I think, 41% or 43% revenue growth year on year, but the share price fell because when the indication was clear that COVID is behind us and Molnupiravir sales will drop now, the share price started to fall. Now, this is a volatility which is not 1:1 correlated with fundamentals, and hence can't be predicted really. It becomes very speculative and risky. And hence staying invested, albeit taking benefit of dislocations through position sizing, is what we've done and continue to do so in Divis. Secondly, Dr. Lal Pathlabs, moving on to the next talk, this firm reported results 2 days ago. And there was a little bit of a weakness. Instead of, say, 15 to 20% growth, they delivered, I think, mid-teens growth, or 15% year-on-year, including Suburban, and excluding Suburban around high single digits on a year-on-year basis. But what's quite remarkable here is there's massive market share gain quarter after quarter, right? The table in front of you shows it. Metropolis is actually the healthiest amongst the competitors listed for Dr. Lal. If we were to add SRL, Thyrocare, etc., the picture will be even wider gap between Dr. Lal and competition. And this market share gain is something that is the biggest area of comfort. Remember, this is without acquisitions. This doesn't include Suburban. The numbers that you see, this is core organic growth, ex-COVID businesses that Dr. Lal is witnessing on a 3-year CAGR basis. So that, again, we are not dealing with one-offs because of base effects of Delta wave and pent-up demand after that, so on and so forth. What this firm is doing is quite remarkable around incremental progress around migration of all their backend to cloud, and driving from that data analytics based sort of control tower initiatives, which some of you might have heard us talk about in our previous webinars, where they've automated the monitoring and management of turnaround times between sample collection and report generation across the country, with a team of only 20 odd people centralized sitting in Delhi, doing this day in, day out using technology. On top of it, a lot of automation of quality checks, which again provides massive sort of operating efficiencies to the business and trust building on an ongoing basis with the medical fraternity and also the patients. One thing particularly noticeable here is 6 months back, there was a lot of talk about Tata 1mg, PharmEasy, and various other e-pharmacy players trying to disrupt through sort of accelerated discounting, so on and so forth. It's quite interesting to see how quickly that competition has reduced in its intensity, because it was first of all not successful beyond a point. Beyond wellness, there was no success in illness through that competitive approach, and illness is 90% of the diagnostics industry. And secondly, it was also not sustainable, not successful, not sustainable. Hence, it has started to moderate quite significantly. Credit to Dr. Lal for running the business the way they have been as market leaders, and massive opportunity in future through Suburban to enter into West and expand the Western presence and hence dominate beyond North, which was the only area till 2016-17 in a large way. NCR used to be sort of 70-80% 10 years ago, and North used to be 70-80% 5-6 years ago, and today North is far less than 50. NCR particularly is less than, I think, even 40. So expanding beyond the core geographically successfully in East, and now potentially in West in future. Massive growth opportunities for this business, which we believe we'll all benefit as shareholders. The third company out of the sort of 10 or 11 that have reported results, only 3 have been weak, rest have been exceptionally strong. HDFC Life, and this table sort of summarizes the comfort level despite sort of low single digit, mid single digit revenue growth, premium growth that HDFC Life reported in the second quarter on a year-on-year basis. As I previously mentioned, the market growth itself was pretty modest because of high base after the Delta quarter's pent-up demand in the September 21 quarter, and also because of some of the products sort of losing traction given the external environment. But particularly interesting to note the premium growth of players like Max, ICICI Prudential, SBI in the second quarter, and how the market shares have progressed over the last couple of years and over the last 10 years as well, which is the table on the right. Quite a high degree of conviction here. Obviously, the share price hasn't moved, which we agree, despite all this market share gain and healthy numbers being reported. Prior to this quarter, they were clocking 18, 20, 22% run rate at top line, bottom line levels. But that's just, I think, a matter of time when share prices eventually start catching up with fundamentals. Other than that, a lot of strength elsewhere. This is, as I was previously talking about, Asian Paints, a company which is already more than 50% market share in a very large industry. Not an easy thing to then achieve a 15 to 20% 3-year CAGR in volumes, quarter after quarter after quarter, through a lot of disruptive action, through a lot of distribution channel expansion, new product introduction, so on and so forth. So I guess we'll stop here. There's a lot of other positive stuff around Titan, Bajaj Finance that we've talked about in our previous webinars. Happy to throw more light on that in the questions if they are there. Salil, if you can help us sort of answer some questions.
Yes, Rakshit, yes. Thanks. Right. So, we'll first start with a question that is on the current theme, right, of the webinar as well as the newsletter you just wrote, is disruption. And the question is that any disruption will have this coming from Shobhan Ganguly. The question is, any disruption has a finite lifetime before competition picks it up, and disrupt the cycles get disrupted. Now, is there some way we can assess that a company will have or will not kind of have one disruption and then just kind of stay still, not do anything? How do we assess the recurrence?
Yeah, so there's a very a clearly laid out process which we follow at Marcellus. We call it the lethargy test. If you've read our previous newsletters, then you would have probably gone through the construct a little bit. We also talk about lethargy score based on the outcome of the lethargy test. And this is all about capital allocation. There are three areas in which capital allocation is assessed at Marcellus for any stock. One, which is the simplest one, is doing more of the same in a better way, which is not really disruption. It is incremental deepening of moats, right? But the second and the third are adding new revenue growth drivers and radically disrupting the shape of the industry, right? That's the second and the third. So there's a specific process laid out and a specific attribution of scoring in our internal frameworks on which we rate companies. Now, as you very rightly picked up, if you don't disrupt repeatedly and you disrupt it only once, then things won't last forever. And there are several examples. I mean, one of the reasons why we exited from Marico, I think three years ago, exactly 3 years ago, was this, because they did disrupt the copra procurement and parachute coconut oil and then Saffola and value-added hair oils. But after a point of time, after a couple of decades, we could see the intensity of disruption dropping down. Unilever is a perfect example, right? Unilever was a clear disruptor, initially around capital allocation towards M&A during the 90s, and then massive disruption around systems and processes to expand distribution and carry out brand creation, marketing, right, through media. But last 10 years, we've not seen much of disruptive action from Unilever, and you can see the impact of that on growth rates, right? So their core is still protected. No Patanjali can overnight come and take it away, but there are no new non-cores getting created and getting added to the core through disruptive activity. And if you don't do that, then as you're rightly picking up in the question, you will see moderation in growth or probably decline in growth as well in future, which is where capital reinvestment towards disruptive activity is very, very important. And hence, rather than sort of talking about history through these bubbles, what is very important is to understand what is happening around the future disruption for various of these businesses, which is highlighted on this slide, right? Had Titan stopped disrupting industries after the keratometer disruption of Tanishq, right? Obviously, you could have seen, if not now, after 5 years, growth moderating down, right? But now that there is Carrot Lane, now that there is eyewear as a potential, and there are various other experiments being carried out in a disruptive fashion, right? That's what keeps us convinced about such businesses. The process here has to be, first of all, assess the agility, the drive, the enterprise that the business is demonstrating through capital allocation. Then understand if a Titan, a Bajaj Finance, an Asian Paints is entering into a new industry and just trying to replicate what an existing player is doing, which is not offering disruption. If that is the case, then don't get excited. It will be short lasting. But if it's not the same old, it's actually radically new way of dealing with the industry, then it's quite disruptive. And here again, I think worth emphasizing that this disruption might not be only a pure tech company, right? These companies, they disrupt year after year after year. And these forays need to be tracked very closely. Back to you, Salil.
Thanks, Rakshit. Yeah. So the next couple of questions are on the insurance names, right? The chart that you showed in terms of the table that you showed on the growth, it's clearly that HDFC Life stand out. The quarter results you showed that both of them have done well. Why are the stocks performing? That's the essence of the questions.
Yeah, so that I think is applicable not just to insurance. Even HDFC Bank, and I would actually say barring Bajaj Finance, all the others, and even the Bajaj Finance has gotten derated in a way. All the others have undergone a disconnect between their fundamental progression and share price progression in the last couple of years. Partly it's a common observation across high quality names, right? So whether it be quality oriented portfolio of Marcellus or quality oriented portfolio of anyone in India, outside of India, the alpha that quality used to generate till a year ago hasn't come through in the last 12 months. Now, is this something which is alarming? So again, there are 2 or 3 ways to understand why it is not something that you should be overly worried about. One, I think this is something that keeps happening time and again, once or twice in a decade across the world, particularly as we explained in, I think, the last webinar. If you look at Berkshire Hathaway, which has the longest standing track record of consistently generating alpha over long term through quality investing, there have been several consecutive 12-month periods for a Berkshire Hathaway to underperform. And just as a reminder, I'll see if I have those charts here. Probably not. But just go back to newsletter we published a couple of months ago. 50% of monthly returns for a Berkshire have been underperforming versus index. 30% of 12-month return for a Berkshire have been underperforming versus the index, despite being sort of very successful over a longer term. So that's one. The second way to understand this is over the longer term, there is nothing other than fundamentals that drives share prices, and that connection cannot be broken down. You can't have companies compounding fundamentals at 10%, growing share prices at 15 or 20 over 5 years, and companies compounding fundamentals at 20, growing share prices at 10% over 5 years. Right? That disconnect does narrow down. Always it does. At times after 12 to 15 months, at times after 24 months, nobody can predict the duration. But over a 3, 5, 7 year period, this disconnect has never existed in the past and unlikely to exist in future either. So, I mean, we remain focused on sort of keeping a very close watch on fundamentals. We do explain time and again the reason why we are not worried about this disconnect. But I think beyond a point, as long as fundamentals keep delivering, you shouldn't be concerned. You shouldn't be concerned.
All right. The next question, again, back on the disruption bit, is that Bajaj Finance, where would you see them in both the digital transformation journey or, if you call it, disruption journey? And is there any evidence that there are results to say that it has been successful, it can be successful?
So very good question in a way, because this is one of the most disruptive companies that we've got in our portfolio. In the last 10 years, if you really notice, Bajaj Finance scaled up from being a consumer durables lender to being a very diversified lender today. So much so that 1/3 of their loan book today is home loans, right? Nobody expected 10 years ago consumer durable lender to also enter successfully into home loans and sustain at an overall level a 20% plus ROE. Right, for the firm, obviously not for the home loan bit, which is a little lower ROE business, but overall very healthy rate of growth. More importantly, they've kept on doing cross-sell, upsell to the existing customer base as they've gone along. Right, obviously new customer addition keeps happening, but every now and then you see 65 to 75% of their disbursements being to existing customers, which obviously is a very different way to carry out the asset expansion for a lender. At the same time, the liability side is something which is an incredible strength for an NBFC like Bajaj Finance. Remember, because these companies, the NBFCs are not banks, they don't have low-cost funding structurally available to them, but Bajaj Finance has created, and literally this is another source of disruption that they've done to the liability side of NBFCs, where this firm has created a liabilities franchise which is far stickier and low cost compared to any other NBFC that you would have seen, right? And that gives it the extra ability to sort of pick and choose high quality borrowers rather than go up the risk profile or go down rather deteriorated risk profile in order to grow its loan book, right? Doing fintech on top of it. I mean, fintech is a buzzword, but doing non-lending products and services on top of it for their customers, only existing customers, in effect, adding more value to the existing franchise that they've created rather than burning money to build a new franchise, right? That's something which is far more phenomenal, I would say, than some of our own other portfolio companies, which have had a longer journey of building newer franchises has been. Bajaj Finance is a great example of how you keep disrupting using existing strengths in newer areas, right? This is not incremental deepening of moats, mind you, right? This is completely radical, and this is very, very disruptive in the longer run, which is the reason why, I mean, it's been several years now that people have kept on sort of doubting the asset quality profile of Bajaj Finance, the lack of sustainability of its growth rates, so on and so forth. But the firm continues to deliver. It is not possible without too much of disruption being carried out, especially, and this is a pure tech company. The buzzword disruption applies here, actually, via the tech piece in the best way.
Thanks. Actually, the next question is on Asian Paints, and this Haresh asked that there's a massive capex program that they have announced, right? How does that impact the return ratios, and what could be the impact on fundamental performance there?
So let me put it this way: had they not announced the backward integration capex, had they just announced the capacity expansion in the existing areas as capex, their operating cash flows would have only 20 to 25% of them, max 30%, would have gotten reinvested back into the business, right? And running a 30% reinvestment rate effectively is not healthy enough, provided you don't also see ROCs expanding from 40% to 60 to 80, right? Otherwise, the growth rates will slow down. This is simple mathematics, right? Reinvestment rate and return ratios multiplied together give you the growth rates, right? So to begin with, that's one way to answer your question. That this helps them expand the canvas of capital reinvestment. Having said that, this is not enough as an explanation, because what if the incremental ROC is not high enough, right? Which is where it's important to understand where Asian Paints is investing all of this incremental capex. I think roughly 2,000 to 2,500 crores extra capex has been announced beyond the standard capacity expansion plans that they would have had otherwise in their core businesses. The white cement backward integration, right, which is sort of 500, 600 crores of the capex. That white cement backward integration is a capex that helps their existing white cement dominance that they have, the putty dominance that they've already created. Right? Remember, Asian Paints was not in putty till 6-7 years ago at all. And today, more than a third of the putty organized industry, we understand, is controlled by this company. So it's a large customer base that they've already created, large revenue engine that they've already created. Just that so far, through outsourced manufacturing, that engine has been created without much of profitability attached to it. Backward integration in the putty manufacturing piece and associated new revenue growth drivers getting added through white cement as well, because white cement is the raw material for putty. That's clearly ROC accretive for the putty bit, margin accretive, and hence overall ROC is likely to be healthy and sustained. The VAM and VAE, vinyl acetate monomer, vinyl, the ethylene emulsion ingredient that they have also backward integrated into or announced backward integration for. This piece, which is a much larger piece than the putty backward integration, this piece helps them immensely in sort of sustaining high quality emulsion manufacturing in-house, right? Something that previously they were dependent on the 4 or 5 large manufacturers globally. Now, for VAM, which is vinyl acetate monomer, you can still have some debate about whether they can do it successfully, because really large scale is needed, 300, 350 metric tons, etc., is not the capacity which others have found sustainable. But that's where I think VAE, which is the larger part of that capex, is a more important aspect of capital reinvestment than vinyl acetate monomer. Again, well, the management has said 4-5% incremental margin contribution from this piece of backward integration, but this is how Asian Paints has historically also expanded over a few decades. And then some new product introductions become possible through some of these initiatives, which are literally quote unquote disruptive for the future of the paint industry in India. So that's on the paint business. This is in addition to what they're doing in home decor, which is a lot more capital light, right? And hence, when you combine the whole thing together, I think this is exactly the way large capital allocators globally, right? And those of you who have read the book recommendations that we've given, so The Outsiders is probably the best example by William Thorndike of how businesses have been created decade after decade in non-core areas through capital allocation of this sorts, right? Once you are more than 50% market share in the paint industry, you either go down the Castrol, Colgate, Unilever way of growth moderation, or you use intelligent capital allocation without letting your ROCs get diluted and sustain the growth rates, which is what I think Asian Paints is after.
Great, thanks. Rakshit, now there are 2-3 questions. I'll combine all of them, right? People are asking about why they're seeing shifts in allocation in certain stocks. And broader question there is that are we saying we're position sizing, but actually we're trying to time the market by doing these shifts? So you can throw some light on this aspect.
Okay, so there are 2 types of time the market that somebody can do. One is preemptive, right, which is speculative. We don't believe we have the capability of doing that, and hence we will never do that. What is happening right now is not preemptive at all. We don't expect a certain share price movement in the next 3 months ahead of which we are making these allocation changes. The second is post facto, which is a dislocation gets created and you benefit out of it. In the last 4 years, our existing clients, if you do the maths, it's 2.2%, roughly a little over 200 basis points annualized gain that we have got through post facto rebalancing since inception, right? That's how big it has been. So some part of the ongoing rebalancing activity is more of post-facto rebalancing because there are some stocks where dislocations are wider than others. And you need to build tools to benefit from the uncorrelated aspect of share prices in the short term, right? The second part is a bit of an upgrade to the position sizing tool that we have made internally. And it's a small reset to the upgraded outcome of the position sizing tool that is the reason for the rebalancing. And the outcome of this upgrade is expected to add incremental alpha over the next few years, over the life of the product on an annual basis and very consistently, right? We keep evolving, we keep learning. These portfolio management tools, they keep getting upgraded. So the tools that we've been using in the last 2 years weren't there till 3 years ago. The tools that we are going to use from now on is an upgraded variant of what we've been using so far. In general, let me put it very simply, right? So let's say we have currently 14 stocks in our portfolio. If all the 14 stocks compound their free cash flows at, let's say, 20% or 22% or whatever be the number, right? Then holding all the 14 stocks over, let's say, 3 years, 5 years, 7 years, will give you share price compounding of each of those stocks being 20. But over shorter periods of time, 6 months, 3 months, 9 months, the share price movements will be uncorrelated. Over longer period, it will be highly correlated because their fundamentals are highly correlated in terms of 5-year CAGR of free cash flows and 5-year CAGR of profits. As a result, 5-year CAGR of share prices will also be highly correlated across all the 14 stocks. But over a 6-month period, there will be time spans where a Bajaj Finance goes up when Dr. Lal goes down, or vice versa, or something else. And that sort of creates opportunities to benefit from, which add extra layers of alpha, right? This is, in a way, let me put it this way, the sort of coffee can portfolio that we published in our books, right? It delivered a certain return over long periods, untouched. But if you had done dislocation benefits in the interim, only post facto and hence low risk, right? This is not preemptive, this is not speculative, only post facto. It adds several extra layers on top in terms of alpha. So that's the reason why these rebalances are carried out. You will see that in future as well, just like you've seen that in the past.
Thanks. Rakshit, again, a couple of questions, this time on Meritor Q, right? The new product that Marcellus has launched. And the essence of the question seems to be that, this might dilute the thought process that you guys have built or stood for. Any responses here?
Well, so let me put it this way: Titan doing jewelry and Titan doing eyewear doesn't lead to dilution. So these are separate philosophies, right? It's not the same fund manager, it's not the same analyst team. Quant is a team we built over the last couple of years. That team has worked on a product, a philosophy, which has delivered. The team has run their own money first, and then they've decided to launch it. It's a product which has a separate risk reward than the sort of PMS products in qualitative research, bottom up base that we've already got. And when you compare that against what we do here, it's actually very different approach, very different philosophy. This is bottom up. The other one is more portfolio construction tools only after quant-based stock selection. So the approach is very different. You as a client should certainly be worried if the focus of the CCP fund management team and the analyst team working with the fund managers, if that focus was getting diluted. You should certainly be worried if the bandwidth was getting diluted. You should certainly be worried if there were no benefits to in the long run from evolution of the philosophies, right? So those are the reasons. None of those apply here. They're two separate teams, completely separate. I don't see why there should be any dilution to our understanding of what Divis Lab is doing and Dr. Lal is doing and what Bajaj Finance and Asian Paints is doing, because Marcellus has launched quant based products.
Right. Thanks. That explains. Rakshit, now one question from Shyam Menon is, what impact would rising interest rates have on the value of the businesses, companies that we own? Do multiples get crunched, derated because of rising interest rates? How should one think of this aspect in investing?
Right. So it is a fact that last 12 months have seen rising interest rates, and it is a fact that the last 12 months have seen multiples getting corrected. Are they interdependent on each other, these factors? No, because there have been several historical periods where interest rates have kept falling and the share prices have also kept falling, and vice versa, where interest rates have kept rising and the share prices have also kept rising. So what has happened in the last 12 months is not reflective of fundamental performance impact and hence share price impact. It's not something that that should be read into via the fundamentals, right? So now let me try to explain. There isn't any company in our portfolio where there is debt and hence rising interest rates leads to cost of capital rising for these companies, right? Secondly, there aren't within that, let me also talk about the lenders. In fact, that's the slide displayed in front of you. Banks are far more protected than NBFCs in the rising interest rate environment, particularly because of the kind of liabilities that they have. Amongst the NBFCs, Bajaj Finance is probably the safest. More importantly, if you've got pricing power, you'll not let NIMs compress. You will not let net interest margins compress. ROEs will not be compressed. And hence, we don't see the sort of long-term fundamental for a bank or an NBFC in our portfolio, not weak pricing power, high pricing power stocks only I'm talking about, getting affected by the rising cost of their liabilities, right? The next point, I don't see interest rates rising in India as much as they might need to rise globally. The degree to which global interest rates will be rising, it doesn't affect the fundamentals of our portfolio companies. If the economies there go into a slowdown, recession, etc., you can see even with the kind of tailwinds that TCS is receiving amidst a US recession, revenue growth of 18% even now reported, when there's massive vendor consolidation, cloud migration, and various other tailwinds that the industry is facing, and TCS is beneficiary of that. We don't see fundamentals getting affected. None of the companies in CCP portfolio other than TCS are linked to global demand affected by interest rates. Even Divis, big pharma, is not going to see people taking fewer cough syrups and painkillers because interest rates are going up, right? So in that regard, no impact from the demand side. From the supply side, again, I mean, rising interest rates, if that leads to inflation, if that leads to then ripple effects on other macro variables, in the last 12 months, we've seen the resilience of margins being demonstrated, pricing power, etc. All in all, we don't see the interest rate inflation scenario being any drag on the next 2, 3, 4 year fundamental growth of this portfolio. And results are in front of you. We've been in a rising interest rate and inflationary environment for quite some time now. But the revenue growth, profit growth, free cash flow growth just keeps accelerating for this portfolio quarter after quarter.
Right. A couple of questions on Divis. Right. First, I think is a question. how strong is, in the sense, are the relationships that Divis has with its customers, are these exclusive relationships, or the customer can go and shop for another supplier, right, if they choose to? And the second question is that kind of a more macro theme is that can Divis gain from India building its API capabilities and taking market share away from China?
Right. So I'll have a stab at that. And Sudhanshu, if you can add deeper insights. So on the first one, no, these are not permanent contracts for life. The trust, once it gets eroded, will lead to relationships with big pharma going away, right? So the trust building has to happen on an ongoing basis, a continuous exercise. And in fact, the only way to grow is to keep deepening that trust, right? This is where actually most B2B manufacturers in the pharma industry have failed, particularly in India. And this is where Divis has immensely succeeded in sustaining the trust, right? If the trust is gone, then the big pharma can easily shift manufacturing to some other vendor in future. Remember, if you are talking about custom synthesis products having limited life, then the new contracts coming towards Divis is only going to be an outcome of sustained trust, not just at a point of time having trust. Secondly, yes, there is a massive opportunity if India takes on some of the shift from China in B2B pharma manufacturing. There's a massive opportunity. You don't need to have the scale that China had operated on. Even a fraction of that coming here, a small fraction of that coming here, is a massive growth opportunity for Indian pharma companies. And again, in terms of the contenders who will benefit from this opportunity, Divis is miles ahead of other pharma manufacturers, particularly around scale of manufacturing, along with efficiency of manufacturing, right? What you saw in the last bullet being explained by Sudhanshu previously around what happened after Molnupiravil's success, that Divis has started to receive a new type of customer demand in the custom synthesis business with high certainty, high volume. That's nothing but incremental deepening of trust, right? So this is as good as it can be progressing on an ongoing basis. Sudhanshu, anything else you want to add on top of this?
Yeah, sure. So basically on this exclusivity piece, there are a couple of regulatory aspects also which prevent Divis from having exclusive contract with big pharma clients. Because what happens is, as per FDA regulations, each manufacturing line is inspected separately. What the big pharma clients cannot afford is basically their end sales getting impacted due to any mishap at any of those manufacturing lines. So in order to prevent that, what they do is basically have 2 or 3 different suppliers as listed in their filings, but the majority of the supplies come from their preferred suppliers, which in majority of Divis's case happens to be Divis itself. So that is where the exclusivity part probably gets impacted, but there are regulatory aspects why it's not exclusive.
Right, and on the China related opportunity, are we seeing a big shift in India, or Divis particularly benefit from this?
So from the macro perspective, of course, there are many opportunities which are arising, but these are long gestation period projects in the sense these take generally between 2 to 3 years from the time it has to commence at the client's end, not at Divis's end, and then the regulatory approvals, etc., the commercial validation which take place. So these are long gestation periods. But from macro perspective, yes, Divis is very well positioned, both in terms of its capabilities as well as track record, to benefit for all the large volume products which might come to India in the chemistry domain where Divis operates in.
All right. Rakshit, then there's one question on Dr. Lal and Dr. Lal's acquisition, or the most recent acquisition. How do you see the future of this acquisition, especially since the amount committed is large? And does that have a negative or positive impact on both near-term as well as longer-term earnings?
Right. So first of all, no debt was raised to fund this acquisition. That would be a concern because all internal accruals, the cash accumulated on the balance sheet was used here, and Dr. Lal is net cash even now after the acquisition. So it's not a drag on the balance sheet strength at all to begin with. But that's just the starting point. Now, coming to the opportunity of expanding into the West Indian region with Suburban. First and foremost, at the time of acquisition, Suburban was about 45 or 46 laboratories run in a reasonably less efficient manner compared to what Dr. Lal has done in North India and East India in a hub and spoke manner. Right? To quantify, Suburban's margins, EBITDA margins at the time of acquisition were around 10%, and Suburban's Dr. Lal's margins in North and East have been around 30%, right? Roughly 3x that of Suburban. The main reason for lower margins is because the same assets were being sweated harder in a relatively muted manner, as in footfalls, the hub and spoke supply chains, the reach out to the medical fraternity, tie-ups with various hospitals, and positioning of collection centers, the infrastructure behind collection centers, etc., right, was being run in a relatively inefficient way. Let me just give you a simple example. So in North India, if you have to call a phlebotomist to your home, you call up Dr. Lal's customer care number. Very rarely would you call up the phlebotomist directly, right? Or you would call up the local collection center of Dr. Lal. You would not have one-on-one interaction with the phlebotomist or with the doctor who will send the phlebotomist, right? It'll be more centralized way. Whereas in Bombay, those of you on the call who are in Bombay, you would notice, especially till 2-3 years ago, the standard approach would be, I have the phone number of SRL phlebotomist, I have the phone number of Metropolis phlebotomist, let me call them home. That will be the home sample collection. Now, this is just home sample collection. There's massive efficiencies to be had if it becomes more centralized sort of front end rather than decentralized front end, where each phlebotomist is having a relationship with the end customer directly rather than a company having a relationship and then appointing phlebotomists basis best efficiencies to run the sample collection and thereafter report generation. So that's one example. The second is sort of positioning of CCs, collection centers, the positioning of laboratories, and hence building the network around it. Trust levels for Suburban were already reasonably high with the medical fraternity in particular. It's important for the medical fraternity to have trust. It's not that the doctors generate footfalls for the labs anymore. There's no incentivization that Dr. Lal gives, etc. In North and East particularly, but the medical fraternity has their reputation at risk if the reports are inaccurate, generated by not trustworthy laboratory, and the medical fraternity waits for diagnostic reports before the treatment gets kicked off for a suffering patient, where illness is the reason for diagnostic testing rather than wellness, right? So on and so forth. And Suburban had done a reasonably high quality job here in the past with the medical fraternity in Bombay. So those are the low-hanging fruits on leveraging onto which margin expansion of Dr. Lal is one area of potential growth. But that I think is going to be stage 2 of synergies. Stage 1 of synergies is expansion of the footprint itself. Right, Dr. Lal with 45 labs had largely got Bombay only footprint. It wasn't a Maharashtra-wide footprint via Suburban, right? And Suburban's expansion across Maharashtra is the beginning of the opportunity. Maharashtra is a huge state, and hence, and there's no single dominant player who can't be shaken up easily here, in the sense that Hyderabad is dominated by Vijaya, Chennai and surrounding areas are dominated by Aarti scans. There's a firm called Anand in Bangalore. There's no such monopoly which Dr. Lal has to really break into, and hence Suburban becomes the first step is to expand the footprint across the state, which they have already done very successfully in the last 5 years in the eastern India. This requires a massive reference lab getting created, which they have done in Vidya Vihar, and a massive hub and spoke supply chain network getting created. Tech investments is what they can leverage on centrally from north, and hence revenue growth expansion geographically across Maharashtra as the first opportunity, margin expansion thereafter. And that's massive new growth driver getting added. Had this not been done, we don't expect, without Suburban types of capital allocation decisions being there, we don't expect only north and east to organically keep growing for longer than 10 years at a very, very healthy rate, right? Obviously, they'll keep growing at sort of mid-teens, but mid-teens CAGR is not good enough for a company to be part of Marcellus's portfolios. And our conviction is more on the acceleration to that growth rate that Suburban acquisition provides in the longer run.
Great, Rakshit. Thank you. We are out of time, unfortunately. There's one question, actually two questions on an aspect. I think I can answer that directly here is, do we use technical analysis in our research? The answer is no. And the reason we don't use it is because we don't understand how it works or why it works, if at all. If you guys have any more questions, then please write to us at clientsupport@marcellus.in. We look forward to seeing you all in the next webinar. Thank you very much, Rakshit. Thank you, Sudhanshu, for answering all our questions.
Thanks, Salil. Thanks.